Welcome to our tutorial, Market Analysis Part 2. We finished up Part 1 on market analysis by discussing fundamental analysis specific to the Forex market. Let's move on and have a look at the fundamental analysis of the commodities market and what factors must be considered. The fundamental analysis of commodities is heavily focused on the supply and demand factors of the instrument we are trading in question. Demand for a particular commodity represents how many people are willing to purchase that commodity at a specific price. Supply, on the other hand, represents the total production of a commodity plus any other stock reserves, such as crude oil. So in general, high demand for a commodity coupled with a low supply equals a higher price. Other factors like poor weather conditions will have an adverse effect on the production of grains, such as corn, which will result in a lack of supply and an increase in price, assuming that the demand remains the same. Also, it is important to be aware that all commodities are quoted in US dollars, and therefore the strength or weakness of the US currency plays a major role in their price. Commodity markets are also heavily influenced by global economic, social and political factors. For example, political instability in a large oil-producing country could result in a rise in global prices of crude oil. So what are the fundamental factors that impact stock indices? First factor is the strength of the economy where the index is based. If, for example, the US economy is showing high levels of employment and strong consumer spending, this will have a positive impact on the major US indices such as the S&P 500. Another factor is the performance of the industry sector which makes up the index. The Nasdaq index is heavily weighted with technology companies. Advancements in technology resulting in some of these companies reaching a wider market and increasing sales will have a positive impact for the index as a whole. The individual performance of the companies within the index has an obvious impact also. Strong earnings from companies such as Apple and Microsoft will have a positive impact on the S&P 500 where they are quoted. So let's look at the final type of analysis, which is market sentiment. So what is market sentiment? Market sentiment represents the overall attitude of all traders. Their opinions and actions, be they buyers or sellers, sets the tone of the market, and this combined feeling is the market sentiment. As a trader, it is important to consider what the market as a whole is thinking. Is the market bullish or bearish? We may have an opinion that a particular instrument should be going up in price based on our own technical or fundamental analysis. However, we need to remember that if the crowd is pushing the price down, even if this is illogical based on our own analysis, our choice is to go with the crowd and sell, or don't take the trade at all until it makes some sense to us. So what is the best type of analysis? Different traders will have their own views on the market. Some place greater emphasis on charts and technical analysis, while others prefer to base their decisions on fundamental factors such as the news and the sentiment of other traders. The straightforward answer is that not one type of analysis can be called the best. Instead, each type of analysis should complement the other to help form our trading view. So what have we learned? Technical analysis is the methodology of forecasting the direction of prices through the study of past market data taken from charts. Fundamental analysis is the study of news, reports and announcements which are likely to affect the instrument we are trading. Market sentiment is the overall attitude and thoughts of traders across the various markets. An understanding of all three market analyses should bring the greatest trading results.